Hi everyone. Thank you for joining us this afternoon. Apologies for the technical difficulties earlier. Our teams are working to fix video audio issues for videos we'll play later on. So welcome to our first session of First Metro Securities First Access titled 2025 Property Market Outlook. My name is Josh Tew from First Metro Securities Research and I will be hosting today's session. So today's event is in partnership with Colliers Philippines, a leading real estate service and investment management company providing expert advice and strategic solutions to property owners, investors, and developers. This afternoon, our speaker will provide us with a review of the property and real estate market covering the office, residential, hotel, and industrial sectors. He will share insights and recommendations to help the investing public and industry stakeholders identify opportunities and navigate challenges in 2025. Before we proceed with today's session, let me run through some house rules for our event. All attendees will be muted during the presentation. If you have any questions, feel free to type them in the Q&A box, and we will address them shortly during the Q&A session. Moreover, we would like to remind everyone that the views and opinions expressed during the webinar are those of Colliers Philippines and do not necessarily reflect the views or positions of First Metro Securities and the Metro Bank Group. Also, we'll be uploading the webinar recording to our official YouTube channel at First Metro Securities, so you can watch it at your own convenience, as well as the presentation will be shared to you all via email. Finally, it is my pleasure to introduce our esteemed speaker for today, Mr. Roi Bondoc, Colliers Philippines Director and Head of Research. Mr. Roi Bondoc specializes in analyzing the residential, office, retail, leisure, and industrial real estate sectors. He conducts macroeconomic research and evaluates the impact of economic trends on the property market. Additionally, he leads client engagement initiatives, delivering market insights to equity analysts, property investors, and real estate firms. As a recognized expert in the industry, Mr. Bondoc is regularly cited in both local and regional real estate news. His insights have been featured in national news programs and major broadsheets, and he contributes articles to the Philippine Daily Inquirer, the Philippine Star, Business Mirror, and Business World. So without further ado, I will now pass on the floor to Mr. Joey Bondoc.
Hello. Hi, Josh. Can you hear me?
Yes, Sir Joey, you're audible.
Okay. Yes. So, how are you? Let me just prepare my presentation. So, I hope you can see it now.
Yes.
Okay.
Can
Is my audio okay?
Yes, Sir Joey, yes.
Okay. So, yeah. So, thank you, Josh, for the introduction. Again, I'm Joey Bondoc. I'm the head of research at Colliers Philippines, and I'm really excited when Josh mentioned that they're inviting Colliers to provide updates on what's happening to the Philippine property and how will the challenges we're seeing right now develop and how will they affect the growth of the Philippine property market moving forward. Because if you look at the Philippine economy, it's growing, one of the fastest growing economies in Southeast Asia. In fact, the second fastest in 2024, only behind Vietnam. And the forecasts are looking very good. Colliers Philippines, for example, we would always welcome equity analysts and credit rating agencies in our new office in Makati City. And for example, we've spoken with Moody's and AMRO, even IMF, and the forecasts are looking very good, 6 to 8% growth for 2025. But what's really important is that you have major demand drivers. These are the major pillars that we're seeing in the Philippine economy right now, and OFWs continue to really fuel consumer spending across the country. And when you talk about OFWs, of course, they continue to allocate a portion of their remittances for real estate purchases and requirements. And we believe that these remittances will continue to expand moving forward. Again, there are news about some OFWs planning to hold off sending money to the Philippines for a week. But I hope, we tune out this noise and really just focus on what will the impact be on the long term. And of course, if they don't send the money for a week, they'll likely continue and send money after that weekend. So we are still projecting these remittances to be funneled and sent to the Philippines, and that should still propel the Philippine economic growth. What's important is that as more Filipinos send in money to the Philippines, inflation is starting to temper. And what's also noticeable is that as we see a more stifled inflation, of course, the central bank wants to prop up spending in the market, right? And if they want to really drum up interest from Filipino consumers, they need to cut interest rates. And the central bank has been cutting interest rates by about 75 basis points so far. So we started 2024 at 6.5%. We're down to 5.75 basic interest rate. And this is important because if you want to fuel spending, you need to really lower interest rates, especially if you really want to propel spending and expansion of micro, small, and medium enterprises, which also rely on credit. And we have more than 90% of businesses in the Philippines from the MSME sector. And this is really important for them to be encouraged and be enticed to expand operations, employ more people. And we believe that the MSME sector is a major driver of the Philippine property sector. Whether you look at office spaces they are occupying, or the residential units they are buying, the mall spaces that they're also taking up. So it's really the entire property sector that will benefit from these lower interest rate cuts, especially from greater spending that we will be seeing from these micro, small, and medium enterprises. So let me shift to the office segment. The office segment, it cannot be denied that the office segment has been seeing some challenges. If you look at Metro Manila right now, we're seeing the first negative net take up since 2021. What does that indicate? The amount of office spaces that are being filled up right now are much lower compared to office spaces that are being vacated. So more vacant spaces over the spaces that are being occupied, essentially resulting in a negative net take-up. And we saw that in 2024. This is the first time that we recorded this negative net take-up since 2021 at the height of the COVID-19 pandemic. And one of the major contributing factors is the exodus of the POGOs, the offshore gaming companies from China. You also have to note that 2019 was a year when a lot of companies started to occupy office space. And then their 5-year lease term expired in 2024. And after that 5-year lease term, they did not renew, hence resulting in more office spaces being vacated in the market. We're seeing some slowdown, especially prior to the US elections. We have some companies that held off expansion of lease contracts because they wanted to see the results of the US elections and how will it pan out and how will the policies of President Trump, for example, shape the outsourcing or insourcing policy in the United States. So that has yet to be seen, the full impact of this Trump 2.0 presidency. But overall, if you describe the office market in Metro Manila right now, it is a tenant leaning market. What do we mean by tenant leaning market? Previously, from 2017 to 2019, the vacancy in Metro Manila office market was about 5%, less than 5%. And it only started to increase, nearly double in 2020. at the height of the pandemic. Office lease rates have been correcting, meaning they have been declining. And for developers to be able to attract tenants, they really need to lower their lease rates and even offer fit out allowance. And meaning, if you are to lease out an office space for, say, 5 to 10 years, we will give you an allowance. How much will it fit out or furnish your bare office space? We will give you a portion of that allocation just so you would lease out office space, entire office floor for about 5 to 10 years. That's what developers have been doing right now. They have been implementing all these strategies since the start of the pandemic in 2020, in 2021, and these promos, for example, fit out allowances are being implemented since 2021, and they continue to be implemented right now because we have a tenant leaning market, meaning if you are a BPO right now occupying office space, you have the greater elbow room to haggle or negotiate for office lease rates because office lease rates in Metro Manila have corrected by about 40% since 2020. So if you're leasing out office space in Metro Manila at 1,000 pesos per square meter previously, pre-pandemic, you're now leasing out office space at about 600 pesos per square meter. And that's the average, of course. Not all locations are charging that lease rate. But one of the major reasons why we've seen substantial drop in office lease rates is because of this one, vacancy, 19.8%, almost 20%. So essentially, 1 out of 5 floors being leased out in Metro Manila right now is vacant. And again, this is a record high vacancy, an historic high vacancy that we're seeing in Metro Manila. In fact, for this year, we're projecting office vacancy to even breach 20% and reach 22%. And looking at the vacancies here, 2017, 2018, 2019, we have the POGO sector that was really propelling office space take up across Metro Manila. Hence, vacancy during that time was 4%, 5.3%. If you look at this slide here, essentially what is being completed during that period in terms of total office space is also being absorbed by the market. But that is no longer the case. And what developers have been doing right now is, they're looking for other demand drivers. The POGOs have essentially left the Philippines. They have vacated about 1.3 million square meters of office space at the height of the POGO demand across Metro Manila. These offshore gaming companies from China were occupying how much? 1.3 million square meters of office space, 10% of total leasable office space in the capital region in 2019. So if you can see right now from this slide, these developers, office space developers, are now looking at other demand drivers. So the government agencies are another sub-segment that they're trying to attract because the government agencies previously were holding office in old Jurassic office spaces. So they now have to transfer to newer, higher quality office spaces. These are LEED, well, sustainability certified office buildings, premium office buildings in the Bay Area, for example, in Makati. And these office spaces are being offered at a discount. And government agencies, including NBI, DFA, DTI, Department of Tourism, have been taking advantage of lease corrections in the market. This slide gives you an idea of which companies took up office spaces in 2024. And as you can see here, you have the likes of Anco, Telos, so still BPO companies such as Telos occupying office space. KMC is a co-working space company provider. Anco is a retailer from Australia. And after occupying massive retail space in Glorieta, they also took up office spaces. Only proves that if we have more companies that are locating in the Philippines, whether it's a retailer or hotel player or industrial manufacturing company, there's a big possibility that this company would also occupy office space. That's why it's crucial for the property segment to really be attracting all of these major companies worldwide. So again, Anko is an Australian retail giant, and then you have other companies here, including Telos, another major BPO player. And this only indicates that it's still a pretty diverse mix of occupants across Metro Manila. This is what I want to highlight because the office space that is being completed right now, it's much less compared to what we saw 2017 to 2019 pre-pandemic. We're now seeing the completion of about 380,000 square meters of office space across the capital region from 2025 up to 2027. And if you look at the average right now, if you compute for the average 380,000 square meters, not a complicated calculus. If you compare it previously, pre-pandemic, we were seeing the completion of how much? 1 million square meters of office space being completed in Metro Manila. 2017 to 2019, that was a period when developers really ramped up and expedited the completion of office space in Metro Manila because they really wanted to take advantage of the strong demand from POGOs, not just POGOs, but even from BPO companies. Because remember, that was a pre-pandemic period when BPOs were really encouraged and, in fact, mandated to hold operations and hold office in traditional office buildings. Work from home, telecommuting was not yet a popular option at that time. And again, I mentioned that vacancy across the capital region, it's a record high 19.8%. But not all business districts are affected by this elevated level of vacancy in the market right now. And Makati CBD continues to attract a lot of companies. I mentioned earlier ANCO and the other multinational corporations expanding. BPOs continue to choose Makati CBD as their preferred location because, of course, Makati CBD is still the premier financial district. But looking at Makati CBD, vacancy is 8.3%, much lower than the 19.8% average across Metro Manila. What's also positive here is that other business locations, including Ortigas Center, Fort Bonifacio, are recording vacancies that are much lower than the industry average. What's notable also here, and which I really want to point out, look at the figure 2.8 million square meters. That's an office space that remains vacant as of end of 2024. And based on our estimate, it will take about 7 to 8 years to fully absorb this vacant office space in Metro Manila right now. So it will really be a slow grind before we see these office spaces being occupied across the capital region. Developers have been tempering their new launches, their completion, meaning they're not launching a significant amount of office space at this point because they have yet to see this 2.8 million square meters of office space vacant as of end of 2024 being occupied by companies including BPOs, government agencies, or right now we're even seeing AI, software engineering companies, data privacy firms locating in the Philippines. These are shared service companies and are new demand drivers essentially, and hopefully they will help fill the void left by the offshore gaming companies from China or the POGO sector. Let me shift the discussion now to the residential sector. We're seeing a lot of unsold condominium units and developers, as a response to this unsold number of condo units across Metro Manila, have been offering attractive payment terms, whether in the pre-selling uh, stages or those that are ready for occupancy already. So we call them RFO units here. But even in the secondary market, meaning units that have been turned over to their owners, we're seeing substantial price correction because some owners have really been willing to let go of their properties, dispose, and sell them even at a loss because, of course, they are in a dire need to generate cash. Some of them, of course, still affected by the impact of the COVID-19 pandemic. And this is what we're seeing across Metro Manila right now. The good news is that, and somehow tempering this bad news in Metro Manila, there are again some sublocations that are recording sluggish take-up. Not the entire Metro Manila is affected. I want to highlight that. But some locations are still reeling from slower, sluggish take-up. But outside of Metro Manila, the good news is that a lot of condominium units, even house and lot only projects, continue to record a very good, very strong take-up. And I will discuss that in detail later. But interestingly, for the Philippine property market, condominium sales, property sales usually pick up or recover a year after elections, especially presidential elections. I mentioned earlier that we're seeing slower completion of office space across Metro Manila. We're seeing the same trend in the residential sector. Tepid completion of residential units across the capital region. Now we're at what 5,800 new condominium units that will be completed from about 13,000 units completed annually from 2017 to 2019. Look at 2027, only about 1,200 new units will be completed. So just imagine the significant reduction from, say, 16,000 units that were completed in 2017 or 11,000 units in 2019 at the height of the POGO demand across Metro Manila. The only concern, and one of the major concerns that we have, is that vacancy is still increasing in the Bay Area because so much of completion of new condominium units happened in the Bay Area. And this slide tracks the growth of inventory in Metro Manila, especially by sublocation. And the Bay Area outstripped the number of condo units in Ortigas CBD in 2018. It outstripped the total condo supply of Makati CBD in 2021, and it will now overtake Fort Bonifacio in 2025 this year. In fact, it was supposed to overtake Fort Bonifacio last year, if not for some projects delayed in the Bay Area by certain developers third to fourth quarter of 2024. I mentioned earlier, and if you recall, vacancy in the office sector was at its historic high. Well, we're also seeing record high vacancy for the residential market. 24%. That's the vacancy in the secondary market, meaning those units that have been turned over already, and the unit owners are now looking for renters, buyers, those that are willing to acquire units in the secondary market, the resale market. Right now, 24 units out of 100 are vacant. But if you zoom in on each sublocation, and as you can see here clearly, the Bay Area's vacancy, 52%. Essentially, one out of two in the Bay Area is vacant at this point. And while we're seeing corrections in the secondary market, we're still seeing increases of prices in the primary or pre-selling market, as shown by this slide. Whether you go to Makati or Fort Bonifacio or Ortigas Center or Rockwell Center. In fact, the challenge for an investor right now and the opportunity that they face is, will they buy a pre-selling condominium unit at 550,000, a recently launched project, or if they are awash with cash and have the cash to buy unit right now using cold cash, will they acquire a property at much less price, 290,000 pesos? The unit is there already and will probably need some minor refurbishing. But again, if you look at Rockwell, so these are the Lunas, Hidalgos, which are very attractive and much wanted condominium projects in the Rockwell Center, Makati CBD. Again, of course, a premier financial district, still a hub for a lot of expats. So if you buy a upscale to luxury condominium unit, you're still likely to get a renter, a top executive of a multinational corporation, or an expat from embassies, consular offices. So you're now seeing this dynamics in the property market, especially in the residential sector, the shifts in preferences, the reductions or even increases in prices. It varies per subsegment. But when we look at the pre-selling sector, what I want to highlight is that launches and take up, which represents demand, have been declining. On a slide, 2024 launches down 60%, the take up, which represents demand, down 61%. Look at 2017, 2018, 2019. A very good period for the Metro Manila office segment because essentially one major driver of demand at the time was the POGO sector, which President Marcos recently ordered to be banned across the country. But aside from POGOs, you'd understand that during this time, 2017 to 2019, just before the pandemic, there was still a strong demand from local market, the Filipino market, because at that time, Filipinos were still required and even mandated to report to traditional office spaces. And they really need to look for a condominium unit that is within a master plan community that is near their office spaces, office buildings, and for them to be able to enjoy the 15-minute community rule wherein everything is within their reach. But of course, the pandemic happened, the POGOs left the country, the local investors ran out of cash. Some of them lost their jobs. They really had to now withdraw from the pre-selling units that they took up pre-pandemic. So you're now seeing all of these demand drivers and how they affected the vacancies for the secondary, even for the pre-selling sector. A major concern that we have right now is that it will take 98 months for these condominium units to be fully absorbed by the market. And what's notable here is that it will take about 8.2 years. So 98 months translated to years, that's about 8.2 years. And as you can see, we're no longer seeing the remaining inventory life of 1.1 year, 0.9 year, less than 12 months. Again, that was seen at the height of the POGO demand and local demand from Metro Manila employees from 2017 to 2019. We're no longer seeing these demand drivers in Metro Manila, propelling the residential sector. Hence, we're now at a remaining inventory life or the length of time it will take the market to fully absorb the unsold condominium units. Right now, it's at about 8.2 years, although this figure is not fixed because if the average take up over the next 12 months improves and we're no longer seeing substantial addition to the unsold units, meaning developers are tempering launches and then the RFO units are somehow being tempered or being sold by developers because they're offering attractive payment terms, sweetening their payment terms for these completed units, then we're likely to see much lower remaining inventory life. For example, if the unsold units drops to 70,000 and then you have the take up increasing to more than 10,000, for example, over the past 12 months, easily that 8.2 years drops to about 7.5 years. So that is one indicator that will definitely improve if we see this changes in the pre-selling market, in the number of unsold condominium units. The question now is, will we see substantial correction for unsold ready for occupancy units? because right now it's still pretty sizable at about 26,000 units, although not all price segments are affected by this slowdown in the RFO sector because the upscale and luxury, which are condo units from 12 million pesos per unit and up, only cover 5% of the unsold RFOs. The challenge really is from the developers that were very aggressive in launching mid-income units. That's about 3.6 to 12 million. Because one of the major reasons is this is the segment that has been really dependent on mortgage rates. And as you know, mortgage rates have really increased because of elevated interest rates. And while the central bank has been cutting interest rates, the mortgage rates remain elevated, about 7.8 to 8% right now. And what I want to highlight is while not all price segments are affected by the unsold RFO conundrum in Metro Manila, if you look at these sublocations, again, not all submarkets are affected because Ortigas, Rockwell, Fort Bonifacio, and Makati CBD, immediate calculation, about less than 2%. That is their share to total unsold RFOs in Metro Manila right now. But if you look at other areas, say parts of Pasig, Quezon City, Manila, Parañaque, Pasay, they cover nearly 60% of the unsold RFOs in Metro Manila as of end 2024. That's why we believe that this is the market that has been seeing challenges at this point. And of course, we can't deny the fact that one of the major reasons behind the slower take up is because of this condominium oversupply. We're seeing a condominium oversupply because prices of condominiums have significantly increased, in fact, growing by 14% every year from 2017 up to 2023, while salaries have only been growing by about 5% every year. And then we're seeing a condominium price increase because, well, land values have been increasing. Whether you go to Makati or Fort Bonifacio or Ortigas Center, the landowners are not really keen on lowering their land values, and they remain elevated, making it, of course, difficult for developers to lower the pre-selling prices that they offer to the market. Interest rates and mortgage rates remain elevated, as I discussed earlier. And what's important is that prices of construction materials remain elevated, in fact, reaching a 14-year high in 2022 and reflecting the elevated inflation during that year. 2022. But it's not all doom and gloom. And as we always say, there are other demand drivers and recovery enablers in the Metro Manila residential market right now. The RFO promos are getting sweeter, meaning now you don't have to shell out a huge amount of money to be able to transfer to an RFO, ready for occupancy condominium unit. All you have to do is secure bank loan and then transfer, move into that condo unit, and then just pay essentially a monthly rent for up to 36 months. And then after a 36-month period, a portion of what you paid will be deducted to the total contract price, and then the developer will ask you if you now want to buy this condominium unit. Of course, after 3 years, the developer would assume that your purchasing power, your salary probably increased, therefore raising your probability of finally being able to acquire that ready for occupancy condominium unit. The joint venture projects remain very attractive. So they are among the more expensive in the market, 300,000 pesos per square meter, 550,000 pesos per square meter between local developers or even foreign, as well as a local player, a Philippine developer. Again, these are 600,000 pesos, 300,000 pesos per square meter. But they're recording very good take up, sales velocity of about 60 to 100% sold out already. and even condo hotels have become very attractive. So these resort leisure themed projects have been proliferating across the capital region because developers are banking on the growth of the travel and tourism sector of the Philippines. We're attracting how many? About 6 million tourists every year. We peaked at 8.26 million in 2019. The Philippine government has set its lofty goal of enticing 12 million tourists to throw the Philippines a glance in 2020. And hopefully we achieve that. But what's important is that Filipino travelers, international tourists, continue to visit the Philippines. Our airports are being modernized and expanded. And once they visit the Philippines, they'll be enticed to stay here longer. Instead of staying in a hotel, they'll probably stay in these condo hotels. That's why some developers that have a lot of unsold RFOs, especially in the Bay Area, for example, have been converting their projects into condo hotels. And again, whether you go to Cebu, Benguet, imagine Benguet, Bohol, Panglao, Palawan, Davao, Samal, even in Clark, in Pampanga, we're seeing these projects that are really targeting foreign investors, expatriates, a lot of foreign branded residences now being positioned in Clark because they want to capture demand from expats of foreign manufacturers located in the Clark Freeport Zone, in New Clark City, in Capas, and Tarlac. Presidential elections have been a positive to the Philippine property market, especially condominium sales. What's interesting is that we have noticed that condominium sales pick up a year after national elections. 2011, after the election of President Aquino, 2017, after President Duterte's election, and then 2023, after President Marcos assumed the presidency. And one outlier here is 2019. 2019 was a senatorial election year, but why did we see a spike in condominium sales? Well, you probably have an idea. It's the POGO sector. That was a peak period for condominium and sales and office leasing in Metro Manila, mainly because of the POGO demand injecting optimism and confidence to the property market, especially to the Metro Manila condominium and office segments. If you look at condominium sales and how they spiked in terms of prices, it recorded its fastest acceleration during the term of President Duterte, mainly because of the POGO demand and the policy that is favorable to Chinese investors and tourists. At the time, Chinese tourists were being provided with visa upon arrival perks, and then at that time, also, the Chinese were the second biggest source of arrivals. China was the second biggest market during that year, only behind South Korea. In fact, accounting for about a fifth of total international visitors. But again, these Chinese tourists are no longer entering the Philippines compared to what we saw back in 2019. So we need to look for other demand drivers, other markets that we can entice. And hopefully, this should result in greater office leasing and condominium sales. I understand that the Department of Tourism has been aggressive in enticing Indian tourists to visit the Philippines. OFWs have been sending in more money to the Philippines. And what's notable is that the amount of money allocated for real estate, whether it's for leasing or real estate purchases, has been increasing. And in fact, we saw a record high, the highest since 2016. And this is definitely a low hanging fruit for developers. Go outside of the Philippines, do international roadshows, and really market your projects to the OFW market that continues to buy and invest in residential projects, whether it's a condominium in Metro Manila or a residential lot only or house and lot outside, especially in key growth areas, including Central Luzon, Calabarzon, Central Visayas, which covers Cebu, Bohol, Western Visayas, Bacolod, Iloilo, or Davao region. And I would even add to that Northern Mindanao, which covers Cagayan de Oro. So again, developers should really continue to launch the right product at the right price and in an ideal location. A condo hotel, perhaps outside of Metro Manila, a resort leisure themed development that is supported by a golf community, a golf course. That would be a very good proposition at this point. Continue to offer down payment terms and more attractive payment terms, especially in the ready for occupancy market. This is just a slight, quick discussion on REITs. But again, of course, the Philippines, when we talk about REITs, essentially newbie in this market. We only fully implemented it in 2019, despite it being enacted as early as 2009, because they had to hurdle, for example, the float requirement and other taxation issues. But right now, we see more office buildings, some industrial parks and warehouses, even hotels are being divested into REIT companies. So yields right now ranging from about 5.6 to a high of 9%. And hopefully we see more real estate assets being divested into REIT, especially those that are generating recurring income. We always say that in the REIT department, diversification is key. Diversification is crucial to attracting more consumers, more stakeholders, and really to generate much needed cash to be able to expand your office, residential, retail, hotel projects moving forward. So again, we need to rethink REITs and not just focus on the basic indicators that we're seeing right now. Perhaps we need to shake the status quo a bit more and look at other sources of recurring income. Infrastructure projects are another, maybe renewable energy projects also more aggressive diversification of these projects into your REIT portfolio. So this is the property um, cycle that we are in right now. So residential and office, we continue to see lower lease rates because of overhang. Hotel and retail remain very dynamic because of growing lease rates, average daily rates, as well as occupancies. And then industrial. The only concern for industrial assets is that because of new completion that were launched in 2020, 2021, 2022 at the height of the pandemic, those new projects right now will likely put a downward pressure on industrial lease rates, industrial warehouse lease rates. And while they continue to increase in terms of industrial lease rates, they might grow at a slower pace compared to what we saw 2021, 2022 at the height of the COVID-19 pandemic when we saw the resilience of the Philippine industrial sector. So yeah, that concludes my presentation. Again, just to give you an update, so Colliers is very active on social media, so you might want to check out our social media pages on Facebook, Instagram, LinkedIn. We have a YouTube channel also that you may follow so that you can track the latest in the market and get key recommendations from me and my colleagues at Colliers Philippines. So I'm gonna turn the virtual floor over to Josh, and I think after this we will be opening the floor for questions. So Josh.
Yes, all right. Thank you, Sir Joey Bondoc. Yes. Thank you so much for that insightful presentation. I'll let you catch your breath for a while before we proceed to our Q&A portion. So once again, we would like to remind everyone that the views and opinions expressed during this webinar are those of Collier Philippines and do not necessarily reflect the views or positions of First Metro Securities and the Metrobank Group. So for our dear audience, just feel free to type in your questions in the Q&A box. and we'll try to accommodate as much queries as we can. So we're seeing a couple of questions already, actually a lot. So allow us to extend for a few minutes so we can have Sir Joey answer them. Mhm.
Okay, so we're answering questions now.
Wait lang, Sir Joey.
Okay.
Oo. Almost. Okay, I think we're all settled down already. Sir Joey, I'm gonna have to bring you back in the
Mhm.
spotlight as
Okay.
open the floor to our Q&A session. So for our first question, we have here, good afternoon. Some developers are creating townships where some residential units are pitched with office spaces. Would you say that the residential sub-industry has a correlation with the threat in vacancy of office spaces, especially in heavily impacted areas such as the Bay Area?
Mm. Yes. So again, if you reviewed my or you saw my slide earlier, looking at the residential market in the secondary residential sector, what's the vacancy in the Bay Area? 52%. If you look at the office vacancy of the Bay Area, it's more than 30%. So somehow it's aligned, right? And the vacancy in the office sector somehow being reflected also by the office the vacancy in the residential market. So it's actually the trend that we saw at the height of the POGO demand, wherein office developers would be complementing their office towers with residential buildings. Hence, an aggressive completion of new projects in the Bay Area. In fact, if you look at the Bay Area right now, it's seeing some challenges because it has the one of the highest residential stock, one of the biggest residential supply in Metro Manila. But if you look at the office sector, it's not a very big player at this point. And one of the major reasons why, even in terms of retail vacancy, it has the highest retail vacancy in Metro Manila because there's really no demand driver for its retail spaces. So, yeah, you pointed it out correctly. The correlation is there. And let's see how, will this pan out after the next, over the next 12 months, given that those office spaces and residential units have yet to be absorbed by the organic demand drivers, the Filipino businesses and Filipino investors.
Okay. Thank you for that answer. May correlation pala.
I think there's a question here. What is RFO? So RFOs are ready for occupancy unit, meaning that's a condominium unit that is completed already and ready to be occupied. But the problem is we don't have a lot of occupants at this point because prices are still elevated and there are no buyers essentially at this point.
Okay. Thank you for that, Sir Joey. Okay, so for our next question, it will be given that the BSP is expected to decrease interest rates,
Mm.
meaning that the cost of borrowing will subsequently decrease as well. Would you say that the mortgage rates in office and residential sub-industries will also decrease? And patterned with low inflation, consumers have higher purchasing power. Will this indicate higher demand?
Okay, let me start with the RF, the mortgage rates, because yes, it is true that the central bank has been cutting interest rates. But as I also explained earlier, we're not seeing a drastic reduction in terms of mortgage rates, right? It has a lag time, and that's really normal, meaning the central bank has been cutting interest rates, but the mortgage rates in fact remain elevated. So when will the impact be? Well, probably the earliest will be mid of 2025. Let's say, because we track these mortgage rates and we have not seen a substantial cut in mortgage rates, even if the central bank has been reducing the basic policy rate. In terms of office space absorption, the interest rate cut having a significant impact. Well, it will probably have an impact, especially for, again, the micro, small, and medium enterprises that I discussed earlier. Because if you're a small business and it will now be much cheaper for you to borrow money from the central, from banks to expand operations, so well, you're likely to expand, especially growing, especially we're seeing it being complemented by a continuously growing Philippine economy, a growing domestic market with rising purchasing power. But hopefully, this expansion of operations will also result in greater office space take up because, as we saw previously, also while some BPOs have been expanding headcount. They have not been expanding their office footprint. So let's see beyond 2025 if there will be greater um, positives for the office and residential market. And how will the interest rate cuts positively influence take up and improve the overhang that we're seeing right now?
All right, Sir Joey. Okay, so for our next question, it's related to mortgage rates. So, what are mortgage rates right now, and why does higher mortgage rate leads to higher prices? And specifically, which subsector again is dependent on mortgage rates?
So the mortgage rates, again, 7.8 to 8%. Which sector? Well, essentially, it's the mid-income. So that's a 3.6 to 12 million pesos per condominium unit or residential unit, house and lot, for example. This is the most affected because, of course, if you're a mid-level executive, for example, you perhaps do not have the cash to buy the condominium unit, the shell out, for example, 7 million pesos. So you have to depend on bank mortgage rates to support the equity that you have, right? So again, we're seeing slow take up for the mid-income segment because this has been dependent on mortgage rates. And we have not seen a significant reduction in mortgage rates, even the central bank has been cutting interest rates. So let's see if the interest rate cuts will have a positive impact on mortgage rates. Only then will we see probably a greater impact on residential take up, well, not just in Metro Manila, but even outside of the capital region.
Oh, thank you, Sir Joey. So
This is
far, and
actually a very good question. Do you think condos located near university areas which have a consistently captured market every year will still be impacted? Okay. Interestingly, if you look at these condominium projects, they're in fact doing very well. They have very good take-up rates, mainly because they cater to a niche market. So you have the students, for example, they have OFW parents that buy them these condominium units, or perhaps even rent out these condominium units within the university area. So I would say that this is still a segment, a subsegment of the residential sector that is doing relatively well in the market at this point.
hey, thank you, Sir Joey. So far, an interesting discussion. So, to our dear audience, just continue to type in your questions in the Q&A box, and we'll gladly accommodate as much queries as we can. So for our next question, we have the Philippine government has a couple pipeline airport projects for development. Would you say that there is a recommended premium for developers who have hotel and resort exposure close to these airports?
Definitely. I'll give you examples. There is a condominium project within Clark Freeport. And even with the land leasehold ownership arrangement, meaning you're essentially leasing the land, right? Wherein that condominium project is built. This project is attracting very good take up. The last figure that I recall, this condominium project sells at about 21 million pesos per unit. but take up is more than 60%. There are actually two condominium projects with the same leasehold ownership arrangement, but the same price point. We're doing very well. Take up rates of north of 60%. When you go to Cebu, the most expensive condominium there is at about more than 500,000 pesos per square meter. This one is taken up already, meaning 100% sold. It's sold out already. When you go to Davao, there's another project there by a developer. This is being marketed as a resort, leisure themed project. It's also doing very well. What did they do? They partnered with a foreign hospitality brand. So even if the prices are elevated, for as long as you market it well and you position it well, meaning you capture what the market prefers at this point. As I mentioned earlier, condo hotels are very good projects to market these days. They are recording very strong take up. So again, these are anecdotes that we have been seeing, and we have the data, in fact, to support this data that we have been providing to the public.
Okay. Thank you, Sir Joey, for that. For our next question, is there any latest update on the hotel industry and industrial property sectors?
The hotel industry remains strong because again we report hotel sector every 6 months. So the last reporting was in fact conducted end of 2024, and then we reported that end of January of this year. The average hotel occupancy in the entire Metro Manila region is about 63%, north of 60%. Is that a good indicator? It is, because occupancies dropped to 20% at the height of the pandemic in 2021 and then 2022. Imagine occupancies now increasing to about 63%. We peaked at about 72% pre-pandemic, 2019. But note that that was a year when we attracted 8.26 million international tourists, a record high for the Philippines. Hopefully, once we achieve much higher tourist arrivals and greater spending from millennials such as Josh, we will see greater hotel occupancies in Metro Manila. Because I don't know if Josh is into staycationing, but a lot of Filipino employees and millennials are in fact taking advantage of staycation offers being offered by hotel players across Metro Manila and even outside. I know because I am from Pampanga and I usually check hotel rates in Clark, for example. So I think that average daily rates have been increasing. What we have reported is an annual 3% increase starting 2025. And that's a very healthy increase in terms of occupancy and average daily rates. We hope that we see more tourists visiting the Philippines. Again, the government setting a lofty target of 12 million in 2028, right? And given that these new airports are being modernized, being refreshed and expanded, we will be able to accommodate more, because it's a little difficult to try to attract international tourists when we can't even accommodate them. Just look at Bulacan. That airport's capacity will be at about 100 million. Chinese capacity in Singapore is 90 million. So that's a pretty massive airport, right? A game changer, especially for Bulacan landscape. But even in key locations, including Cebu, Clark, Cagayan de Oro, at the height of the pandemic, the occupancies, hotel occupancies in those three localities were ranging from 20 to 30%. When we tracked their occupancies 2024, their occupancies were at about 70 to 80%. So you have the likes of Accor, for example, Mercure, Sofitel. So Sofitel in Manila closed. And that's a sad day for Josh because he likes to, try the spiral buffet. But don't worry, Josh, because Sofitel, I heard, will be opening in Clark. Will be opening. In fact, I think the one in Cebu will open soon. Will welcome guests soon. So you have the likes of Ascot, Citadines, right? Dusit Princess in Cagayan de Oro, in Bukidnon. So imagine, these are new players. Dusit Princess in Batangas. So I think more and more foreign hospitality brands are betting big on Philippine hospitality because our tourism infrastructure is improving and our tourist arrivals are growing.
Okay, Sir Joey, to answer your question, yes, I do like spirals. So,
Okay.
speaking on tourism, what is your outlook for the tourism sector? Particularly, do you think the VAT refund law will help
Uh,
its recovery?
Okay, I think the battery fund, because at some point we try to take advantage of battery fund when we go outside of the Philippines, right? I think the VAT refund, it should, and I hope that the government does this because we will be having an implementing a set of implementing rules and regulations for this VAT refund law. And hopefully these IRR will be, well thought out and well identified. Because, if even if we have this law, but you don't have a one-stop shop for these VAT refunds, how can tourists take advantage of this VAT refund? A maximum of 3,000 is likely still small and will not likely immediately drum up interest in Philippine products. But it's a very good start, we believe. And will it really draw a lot of foreign tourists immediately? I don't see that in the near term, but it will probably help a lot of local businesses here, especially souvenir shops, for example, restaurants, right? So the impact will likely be more on the Philippine enterprises rather than the Philippines attracting more international tourists.
All right, Sir Joey, thank you for that, and I totally agree with that. So moving on to our next question, what is your insight on developing MICE, so meetings, incentives, conferences, and exhibition centers for the pandemic, given that there is a POGO exodus?
Okay, it's actually a very good subsegment in the hospitality sector, and it is in fact a subsegment of the hospitality sector that is somehow isolated from the POGO exodus because MICE is essentially locally driven, meaning you have a lot of briefings. Like, for example, Colliers, we would have four major events per year. And then we would have pocket events also. And where do we hold those briefings? In hotels, right? For example, on April 23, we'll be having a briefing at Marriott in Clark. And these face-to-face events have really been fueling the demand for mice. We believe that even if we have Zoom and MS Teams, nothing really replaces the quality of interaction that we have whenever we have this in-person, face-to-face events. The quality of networking, of course, is really top-notch when we do in-person events. And knowing that the Philippine government has been positioning the Philippines, especially Clark, Davao, and Cebu, as MICECON events, MICECON hubs, not just in the Philippines, but even across Southeast Asia. We're likely to attract major events. For example, I understand that is it August or September of this year when we would be holding a major basketball tournament. So expect, for example, the hotel and MICE facilities near the stadiums where FIBA will be holding those games to really achieve elevated occupancies and daily rates. So that's just an example of how the hotels will be positively influenced by more MICE events. For example, the Rotary International events. Unfortunately, I think we failed to win the bid to hold the major Rotary International event in the Philippines. Hopefully, in the future, when we get the opportunity to host these events, then those will probably be very beneficial to the local hospitality sector, especially for hotels here in the Philippines, especially in those MICE hubs that I mentioned. So you have Clark, of course, Cebu, and then Davao.
All right. Thank you for that, Sir Joey. So moving on for our other question, we have which is better to buy foreclosed properties or outside? Um, I guess this question is talking about which is a better option, purchasing a foreclosed property versus
Residential.
RPO versus
Okay.
pre-selling.
I think, when you talk about foreclosed properties, my first recommendation would be to shop around and look for the best payment term, the best price that developers can offer. Again, I'll give you examples. One developer is no longer requiring a hefty cash out for you to be able to transfer to their ready for occupancy RFO unit. You essentially just pay the monthly payment, essentially renting it. Some developers, when you go outside of Metro Manila, they even have projects that they offer to investors. If you pay spot cash payment, you get a 42% discount. So those are hefty discounts being offered by developers because they want to move the needle, so to speak, meaning move their inventory and make sure that they sell out significant number of these unsold condominium units and even house and lot only projects at this point. But where is the growth happening? I would say, and just to be safe about this, when you look at residential loans, where are they being offered, or which regions are taking up much of the real estate loans? Outside of Metro Manila, it's Central Luzon. So you have the likes of Pampanga, Bulacan, Tarlac, and then Calabarzon also, Cavite, Laguna, Batangas, Central Visayas, so Cebu, Bohol, Western Visayas, again, Negros Occidental, actually Bacolod City, Iloilo, and then Davao region, of course, and then Northern Mindanao, Cagayan de Oro. Those are the regions accounting outside of Metro Manila, a huge part of total residential real estate loans. If you add Metro Manila to those regions, they cover more than 90% of total residential real estate loans, only indicating that much of the activities and the loans and purchases are happening within those key growth regions.
Okay, thank you, Sir Joey, for that. So we've
Mhm.
extended past the 1 hour mark, but please continue to type in your questions in the Q&A box, and we'll gladly accommodate as much queries while we have Sir Joey with us in this
This is
afternoon.
interesting question. I think it's from I don't know, Kenneth. It's a question about the 8 to 12 million. Sorry, if you can help me track it. Uh,
Ah,
how
yes.
about the newly launched condominiums price at 8 to 12 million, which fall within the segment? Fall within. Sorry, I cannot.
Sir Joey,
Within
do you
this.
want to read it?
Sorry, yeah. Can you read it, please?
Okay.
Medyo
How
nagkano
about
yung magalaw
okay.
yung.
Sige. So this question is, how about newly launched condominiums priced at
Mm,
1 to 12 million, which fall within the segment reportedly affected by oversupply? Do you think
mm,
condos located near university areas, which have a consistently captured market every year, will still be impacted by
mm.
by these
Yeah,
property challenges?
again, yeah. Well, that's a reason why I mentioned earlier. When you talk about a condominium oversupply, a slowdown in take up, you don't have to look at it on a more macro point of view. You really have to dissect where that oversupply is coming from and where that slowdown is directed towards. For example, yes, 8 to 12 million is, again, it's part of the upper mid income segment, which I mentioned earlier is a segment that continues to see challenges. But looking at the demand driver, it's targeted towards a niche market, right? The student areas, university areas, wherein much of the demand coming from OFWs, and OFWs continue to invest here in the Philippines. They rent the units for their children studying in those universities. Or, if you are an astute investor, you're probably investing in that area because you know that students will continue to enroll and will continue to be located in those university areas, hence a stable source of demand, right? So that's how we explain the dynamics, and that's why as I highlighted earlier, while there are some unsold condominium units, not all locations are affected, and not all price segments are reeling from this condo oversupply or slowdown that we have been mentioning. You need to really dissect and give it a more microscopic view.
All right. Thank you, Sir Joey, for that. So, moving on to our next question. So, are we seeing the same story in the office sector located in the provincial area?
Mm.
So,
Okay.
mm,
If you look at the office sector outside of Metro Manila, it's a mixed bag, I would say, at this point. So, for example, when you go to Pampanga in Clark, um, near SM Clark, for example, you have new players there in touch, occupying an entire floor. You have new players, for example, in Cebu. I remember Concentrix is one of our major players in Cebu, occupying massive space there. It's a relatively new building that was 2022, 2023, if I'm not mistaken. We have two major BPOs, in fact, scrambling for office space in Davao because there's not a lot of office space in Davao. We are having a difficult time locating a BPO company in Pangasinan because apparently there is a dearth, a lack of quality office space, a BPO friendly office space configuration in Pangasinan. So overall, when you go to these submarkets, the vacancy is still elevated somehow. Of sample, 20%, north of 20%, a little higher than the Metro Manila average. But note that much of these office spaces, for example, in Cebu, Iloilo rather, we're seeing an elevated level of vacancy in Iloilo, mainly because at one point, at the height of the pandemic, the office vacancy in Iloilo City was only about 7%. The only reason why we saw a substantial pickup in office vacancy in Iloilo is because of the completion of new office spaces that were launched pre-pandemic. They were not able, of course, to factor in the pandemic, and only now that we see the completion of these office spaces, hence resulting in elevated vacancy. But outside of Metro Manila, we still see a lot of interest. And hopefully, as these BPOs locate in those areas, we see the office space vacancy in Iloilo, Cebu, Pampanga, Davao, eventually reducing further.
all right. Thank you, Sir Joey, for that
Thank
again.
you.
Very insightful.
Yeah.
And this is regarding the residential side naman. So, do you foresee prices significantly down for residentials? And just a follow-up question on that. And what do you think what do you think will drive demand for these residentials?
Yeah. Well, again, if you look at the prices, it will depend on which location are you pointing out, because and which segment also. Because yes, we're seeing correction in the secondary market, whether you go to Makati CBD or Tiga Center, Fort Bonifacio, those in the secondary market, meaning turned over already, and the investors are looking for buyers in the resell stages. We're seeing price corrections, price reductions. But in terms of reselling, because much the developers still hold these condominium inventory, they're unlikely to lower the prices of these pre-selling condominium units. What they do is they extend the down payment term. So even at offer more attractive, ready for occupancy, move in term. So you don't, have to have a hefty cash out initial outlay all you have to do is essentially rent out the ready for occupancy RFO condominium unit. Where will the price increase come from? It will likely come from outside of Metro Manila, especially for horizontal, meaning house and lot, and residential lot only projects. Because as our data shows, 2017 to 2024, when you look at lot only and house and lot projects in Calabarzon, Central Luzon, Central Visayas, Western Visayas, Davao region, prices of these projects increased by an average of about 5 to 12% annually from 2017 to 2024, making them essentially practically very good hedges or protection against inflation. And especially one reason why we're seeing a strong take up for these projects is because they are receiving a strong end user demand, meaning the take up is dependent on the end user market. If I buy it, I live in it, not the other way around, meaning not buy it and then resell it and then speculate on the price increase or the rental prospect of that property. So, and which segment drives demand? As I mentioned, one of the major demand drivers, the OFW sector. So I think the OFW sector, while some segments are calling for non-remittance of OFW money for a week. I think that that's an absurd idea, but I think that overall the OFW segment is a low-hanging fruit for the Philippine property market beyond 2025.
All right. Thank you, Sir Joey, for that. So this next question is regarding the Pogo exit. So
Mm,
there is elevated vacancy rates due to the Pogo exit. So do you have
mm.
an estimate on how significant this can impact PHL's GTP? And also, can you give some picture on how big were Pogos as a percentage of the rental or buying market during their peak?
The POGOs, when you talk about the office sector, they covered about 1.3 million square meters of office space in 2019. That's about 10% of total leasable office space during that period. And that was a peak period, peak year for the office space take up from the POGO sector. When you look at their influence in terms of residential vacancy, I'll give you one example. Just before the Pogo exodus, the vacancy in the Bay Area, where much of these Pogo employees were concentrated anyway, is at about 25, 26%. Easily, when all these Pogo employees returned to China or other Southeast Asian countries, the vacancy of the residential market in the Bay Area doubled to about 52%. So that gives you an idea of the impact of the Pogo exodus and the Pogo ban implemented by President Marcos on the office and the residential sectors.
All right. Thank you, Sir Joey, for that. So another question, it's with regard to the shift to suburbia. How do
Okay.
you see developers should respond with this opportunity? Where should the focus be?
The shift to suburbia, meaning developers really taking advantage of strong investor and end user demand outside of Metro Manila. And where is the demand coming from? Well, essentially, where the developers are land banking and developing at this point, similar to the regions that I mentioned earlier: Central Luzon, Calabarzon, Central Visayas, Western Visayas, Davao region, and Northern Mindanao. We still see new master plan communities, townships being launched, for example, in New Clark City, in Capas, Tarlac, in Porac, in Pampanga, Angeles City, in Pampanga, Bulacan. So you have a major developer that launched a massive township and essentially offering it as the and marketing it as the BGC of the north. And then you have new estates being launched by developers in Bacolod, in Iloilo, in Davao, for instance, even by homegrown local players. I would say that where are these major townships located and which regions are the developers maximizing? Well, it's those regions that I mentioned earlier.
All right. Thank you, Sir Joey, for that. So, we'll be having our last question for this webinar as we exceeded the 1 hour time limit for this webinar. So for our last question, it's a question regarding an investment. So he's invested in Condo Bay area before the pandemic with good rental income that time. But now all the rentals are down and he's caught up with a huge bank amortization. So any projections on how long will Bay Area recover?
I hope I have a crystal ball for that. But looking at the vacancy of the Bay Area, again, in the residential sector pre-pandemic, office vacancy, for example, the Bay Area's vacancy was only 5%. Now it's more than 30%. In the residential sector, just before the POGO ban, the Bay Area's vacancy was already 6%, and then it only spiked to 52% because of this POGO exodus. The period, definitely it will be difficult to determine because unless we see new demand drivers in the Bay Area, we are unlikely to see a significant improvement in terms of residential and office take up in that business location. But there will be demand drivers, of course. Again, some developers are aggressively marketing their condominium projects as condotel at this point. Because what we have observed is that every fourth quarter of each year, the hotels in the Bay Area actually record the highest occupancy. Mainly, and we think that that is because of foreign arrivals, balikbayans come to the Philippines, making Metro Manila, the Bay Area as their pit stop just before they go to other parts of the Philippines, right? Boracay, Siargao, and or Cebu, for example. And there are other demand drivers, again, AI, software engineering companies, data privacy companies occupying office space right now, not yet in the Bay Area, but hopefully we see more demand drivers. For example, there are seafarer manpower deployment companies occupying office space in the Bay Area. And hopefully that will result in greater take-up for hotels, condotels, residential units being offered to the Airbnb market because you have, for example, seafarers that will eventually be deployed abroad and they need condominium units, residential units to stay in for the next couple of weeks or just before they leave the Philippines. One of the major reasons why we saw a substantial increase in vacancy in the Bay Area is because of the POGO sector, essentially driving take up. If you were a mid-level executive at that time, 2017, 2018, 2019, a developer probably told you, oh, you buy a condominium unit from us because of POGO employees, you'll be able to earn double of how much you're paying monthly for your condominium unit. So you were enticed to buy multiple units. But you know what happened in 2020? The pandemic happened, the POGOs vacated their residential units, and you'll be lucky if you were left with one condominium unit, and then you have no choice but to return the other two units, for example, to the developer, to the inventory of that certain developer. But right now, we're not seeing massive recovery in neighbors for the Bay Area. It might take um, a few more years before we see substantial improvement in terms of office, residential, and even retail take up for the Bay Area. But outside of the Bay Area, as I mentioned, there are other sub-locations and business hubs that are doing much better. Again, the more established business hubs, including Makati, Fort Bonifacio, as well as Ortigas Center, are performing well and are recording vacancies, office or residential, that are much lower much better than the industry averages at this point.
So, all right. Thank you again, Sir Joey,
Thank
for
you.
all the answers. And so, thank you very much, Mr. Bondoc, for a thorough and well-crafted presentation and the lively exchange during our Q&A. Also, thank you everyone for the active discussion on the 2024 performance of the property and real estate market, as well as its 2025 outlook. So once again, we'll be uploading the webinar recording to our official YouTube channel at First Metro Securities, so you can watch it at your own convenience, as well as the presentation will be shared to all of you via email. So for the remaining unanswered questions, don't worry, we will be sending Mr. Bondoc's answers via email as well. So finally, to help us improve the quality of our webinars, we kindly request for 2 minutes of your time to fill out our feedback form for this session with Colliers. You may scan the QR code flashed on your screens. So this special briefing with Colliers Philippines was made possible by First Metro Securities. This is your host, Josh Tew, and a big thank you once again to Mr. Joey Bondoc and to our audience for your time and engagement. We appreciate your participation and look forward to seeing you at our future events. Have a great day, everyone. Thank you again.